We're approaching the start of a new tax year, and if you own your own business, you're probably asking yourself, what is the most tax efficient way to pay myself in 2025-2026? In this video, we're going to look at the three main options for directors of limited companies, and we'll be breaking down the implications of each. Before I begin, please note that the exact answer to this question depends on your actual circumstances, but if you wanted a snap answer without any context, then my recommendation would be to pay yourself a basic salary of £12,570 a year and take the balance in dividends. I'll explain the logic behind this and each of the other two salary mixes now, but if all you wanted was the quick answer without an explanation, please don't forget to give this video a like. Hi, I'm Joe, I'm the founder of E-Commerce Accountants, the UK's leading accountancy for e-commerce businesses. If you're interested in learning more about us, please click the link in the description below. For years, the most tax efficient way of extracting money from your company was through taking a basic salary and dividend payments. However, this year there are large changes to national insurance, and so this has created a few different options which we'll be referring to as the three mixes. Before I jump into the three mixes, it's worth noting that paying yourself dividends is important because this component of the mix allows you to 1. Use your tax-free dividend allowance. 2. Pay lower dividend rates when compared to normal income tax rates. And 3. Avoid national insurance as this is not levied on dividends. It's worth noting that dividends must be paid out of post-corporation tax profits. So there is a drawback to them in that your company must be profitable in order to pay out dividends. Corporation tax, which is 19 to 25%, depending on your company's level of profit and your number of associated companies, will be paid before you receive a dividend. Because of this, we recommend including a basic salary alongside your dividends. This will utilize your tax-free personal allowance, incur little to no national insurance contributions. This is because national insurance contributions don't kick in until your salary passes certain thresholds. Is an allowable business expense, which reduces your company's corporation tax, and it may allow you to achieve a qualifying year for state pension purposes. Dividends do not count towards this. A quick note here, you might be a long way off thinking about retirement, but in order to qualify for the full state pension, you currently need 35 years of qualifying contributions. That number could increase in the future, and as I'll outline shortly, paying yourself mixes 2 and 3 do count as full qualifying years, even though you're making minimal national insurance contributions. Now, onto the three mixes. I'd like to point out that the only difference between each of these mixes will be the size of the salary component. We're assuming that you're going to be taking out as many dividends as possible, so the remainder of your earnings should always be in the form of dividends, as that's the most tax efficient approach. And the amount that you take ultimately depends on how profitable your business is and how much you might want to withdraw from it. For example, how much you need to live or whatever your lifestyle might be. However, the general rule of thumb is to take right up to the higher rate tax threshold, which is where you start paying 40% tax. The other option is to pay yourself up to 100k, after which point you start to lose your tax-free personal allowance. So in general, we usually see business owners paying themselves around 50k in total, because that's where 40% tax starts, or 100k in total, because that's where there's an effective rate of 60%. Just before we dive into each mix, for demonstration purposes, we're going to assume that your sole earnings are from this company and you don't have any other income. For example, job, employment, property, investments, etc. If you do have other income, then that may change the most tax efficient salary and dividend mix. So if that's the case, I'd strongly recommend speaking with an accountant. The best mix for you will depend on the number of staff or employees that you have. So we're going to split this video into two sections. 1, I'm a sole director, i.e. one without any other employees or directors working with me. And 2, my company has 2+ directors, or it's myself and at least one additional employee. Let's start with the sole directors. In this case, you will have 3 options that we're going to share with you. Mix 1, paying yourself a salary of £5,000 per annum while taking the balance in dividends. This is mix 1 on the graph. paying yourself a salary of £416.66 per month, which amounts to £5,000 annually. This matches the secondary threshold of £5,000. Not crossing the secondary threshold means that you will not have any personal tax obligations. You will also not have any employee or employer national insurance obligations. However, the biggest drawback of this is that as your salary is below the lower earnings limit, or LEL, of £6,500 in a year, you will not achieve a qualifying year in terms of state pensions and other benefits. You'd earn the remainder of your income in this mix through dividend payments. The benefit of this mix is that you incur no national insurance obligations. However, because this salary mix does not qualify as a qualifying year for state pensions purposes, I would not recommend it. That is, unless you had another employment at the same time that was qualifying. Mix number 2. Pay yourself £6,500 a year. This is mix 2 on the graph. Paying yourself a salary of £541.66 per month amounts to £6,500 annually. This matches the lower earnings limit, or LEL. In mix 2, you will not have any personal tax obligations, which is the same as in mix 1. However, you will have a small amount of employers' NI obligations, or national insurance obligations. At this level, this will be £225. It's worth noting that these are tax deductible for corporation tax purposes, so the 225 will be offset slightly through corporation tax savings. In this mix, your salary is above the lower earnings limit, or LEL, so you will achieve a qualifying year in terms of a state pension. As before, you'd earn the remainder of your income through dividend payments. Overall, mix 2 is better than mix 1, as although you're incurring a small amount of national insurance, you are achieving a qualifying year for state pension purposes. On top of this, the increased salary and national insurance contributions will be decreasing your corporation tax bill. This leads to an overall greater tax saving than in mix 1. This brings us to mix 3. Pay yourself £12,570 per annum. This is mix 3 on the graph. Paying yourself a salary of £1,047.50 per month amounts to £12,570 annually. This matches the annual tax-free personal allowance. Mix 3 means that you will not have any personal tax obligations, which is exactly the same as mixes 1 and 2. Similar to mix 2, you will have employer national insurance obligations. However, as your salary is higher in this mix, your obligation here is going to be £1,135.50. And similar to mix 2, as your salary is above the lower earnings limit, you will also be achieving a qualifying year in terms of state pensions and other benefits. Like the other two mixes, you'd earn the remainder of your income through dividend payments. With mix 3, you have an increased salary, and you've increased that to £12,570, which is £7,570 above the £5,000 secondary threshold. Meaning, this segment of your income is subject to employers' national insurance at 15%, which, although this results in £1,135.50 of employers' national insurance, this additional burden is offset by overall corporation tax savings. To put it another way, as opposed to mix 1, which was £5,000 salary, no national insurance obligations, in mix 3, your salary expense is increased by £7,570 plus the employer's national insurance of £1,135.50, which is a total tax deductible expense of £8,705.50 for your company. If we take the lowest possible corporation tax of 19%, then this will reduce your corporation tax by £1,654.05, which you will note is a saving of £518.55 more than the additional £1,135.50 NI bill incurred through this mix. It's also worth noting that if your profits are above £50,000, then although increasing your salary might incur more national insurance, it could be tax efficient, as the increased salary will decrease your profits, and if it brings those profits down to less than £50,000, then it could lower your company into a lower corporation tax bracket. This is why there's not actually a one-size-fits-all approach. Again, I'd like to emphasize, please speak with your accountant if you're not sure. So let's recap. Which mix is best so far? For sole directors with no other employees, this table shows who each mix is best for. Mix 1 with a £5,000 salary. This mix is best if you wish to leverage part of your tax-free personal allowance while avoiding payroll liabilities altogether. The downside here is you lose out on a qualifying year in terms of state pension. Mix 2. With a £6,500 annual salary, this mix is ideal if you wish to gain a qualifying year for state pensions at the lowest possible cost, but with the additional employer NI obligation of £225 a year. Mix 3. With a £12,570 annual salary, this mix suits those wanting to leverage their personal allowance in full and gain a qualifying year for state pensions. While this carries an employer NI obligation of £1,135.50, this does result in tax savings overall when you look at the amount of savings offset by corporation tax. Side note, if you're one of our payroll clients, we'd recommend Mix 3 because we'll stay on top of all the obligations for you. If you'd like our help with this, please click the link in the description below. So, that's how the mixes work for companies with a sole director. But what about for companies with 2 or more directors/ employees? So why are things different when you've got more than one employee? Well, once you have more than one person on the payroll making national insurance contributions, your business is then eligible or should be eligible for the employment allowance. This allowance can be applied to your employer national insurance contributions up to £10,500 in the tax year 2026. It's worth noting that this is per company, not per employee, meaning if you have employer national insurance contributions of £10,500 or less, it should be cleared by the employment allowance completely. Because of the employment allowance, there is only one salary mix that we recommend for companies that qualify. That is Mix 3. Pay yourself £12,570 per annum, along with any other directors. This mix will leverage the employment allowance and your personal tax-free allowance each year. For example, if you and your company had 2 directors, you would pay yourself and the second director a salary of £1,047.50 per month, which amounts to £12,570 each annually, matching the personal tax-free allowance for both of you. For both directors, this would mean that neither of you would have any personal tax obligations. You won't incur any employee national insurance obligations, and due to the employment allowance, you won't have any employer national insurance obligations either. Both of your salaries will be above the lower earnings limit, meaning you will both achieve a qualifying year in terms of state pension and other benefits. In most cases, Mix 3's use of the personal allowance and the employment allowance makes sense. For example, in the case of 2 directors earning £12,570, as the secondary threshold is £5,000, both employees are earning £7,570 above the Class 1 NIS secondary threshold. As 7,570 times 2 is 15,140, this means that the 15,140 will also be subject to 15% employer's national insurance, totaling £2,271. However, as the first £10,500 of employer's national insurance is covered by the employment allowance, there should actually be no liability. Now, there could be an argument to increase your salary even further. This is to fully utilise the employment allowance and use your salary as a business expense to offset your corporation tax bill. However, as there are quite a lot of variables with this, for example, you might have additional employees, there might be additional directors, we don't know what other income you have. It's not something I'm going to explore further in this video, but worth noting if you're in that situation. One thing to point out is that if you do increase your salary beyond the point that we've mentioned, then you do start to incur employees' national insurance contributions. Those are the 3 tax efficient mixes for 2025-2026 that we think business owners should be thinking about. In general, Mix 3 is the standout winner and is always going to be the one that I would recommend. But there are niche circumstances where it's still worth considering mixes 1 and 2. If you found this video helpful, please drop us a like and consider subscribing so you don't miss out on any videos similar to this one. Below you can find some more important links, one to our full blog post covering these mixes in detail, and another to book your discovery call if you'd like to work with us. Thanks so much for watching, and I'll catch you in the next video.